Hello and welcome everybody to the Ultimate Candlestick Charting Guide. My name is David and I am the head trader at TradingLearning101. If you're new to the channel, please hit that subscribe button. Join the Trading Learning 101 community where we all grow as traders and investors. What you will be learning in this guide: the history of Japanese candlesticks, why candles are important, the types of candles and popular candles, candlestick formations, blending candlesticks, and volume. I have spent 2 weeks putting this project together and compiling information to help you as an investor and trader. I hope you enjoy. First, we'll start with what is a line chart. A line chart is the most popular chart and the most common chart people see when just getting into the stock market. A line chart is a graphical representation of an asset's historical price action that connects a series of data points with a continuous line. This is the most basic type of chart used in finance and typically only depicts a security's closing prices over time. Line charts can be used on any time frame, but most often using day-to-day price changes. Bar charts show multiple price bars over time. Each bar shows how the price moved over a specific period of time. A daily bar chart shows a price bar for each day. Each bar typically shows the open, high, low, and close (OHLC) prices for that period. This may be adjusted to show only the high, low, and close (HLC). Bar charts was used before candlesticks became popular. Bar charts are very similar to candlestick charts, but candlestick charts are more appealing than bar charts. With a bar chart, for an example, they'll either all be one color, black, or they'll color coordinate them, green and red, as you see here on the right. A green bar will open with a dash on the left right here. If it makes a new low, it will have a wick like it does there, and then it will run up, and if it has a high, it'll have an upper wick, and when the bar chart closes, it always closes with a dash on the right. So just remember that with bar chart. Bar charts open with a dash on the left side, and whenever they close with the dash on the right side, like that. And if they make a high or a low on the day, they'll have a wick just like this, just like a candlestick. And you could see all examples of it right here. I personally like using bar charts sometimes just to get an idea of the overall trend. I'll draw trend lines by connecting all of the higher highs on it or higher lows to get an idea, like I said, of the overall trend. Renko charts. Not many people use Renko charts. You may run into a couple people that use them. A Renko chart is a type of chart developed by the Japanese. This is built using price movement rather than both price and standardized time intervals, like most charts are. It is thought to be named after the Japanese word for bricks, renge. Since the chart looks like a series of bricks, a new brick is created when the price moves a specified price amount, and each block is positioned at a 45-degree angle up or down to the prior brick. An up brick is typically colored white or green, while a down brick is typically colored black or red. In the 18th century, a wealthy Japanese businessman, Monahisa Hama, developed a technical analysis method to analyze the price of rice contracts. Today, this technique is called candlestick charting and is widely used when drawing stock charts. Hama from Sakata, Japan, began trading at the local rice exchange around 1750. He kept records of all the market psychology, learning to boost his profits by carefully monitoring prices and not rushing into trades. Hama is regarded as the grandfather of candlesticks because of his research on price pattern recognition. Hama is credited with giving rise to a research technique which became the basis for trading in Japan. Steve Nissen introduced candlestick charting to the Western world in his book Japanese Candlestick Charting Techniques, which is the book on the left, this gold book right here. This was his first published book bringing candlestick charting to the Western world. And when he brought this over, this is when candlesticks became very, very popular with people in the finance field. Then Steve Nissen came out with his second book, Beyond Candlesticks, which is here on the right side. Both of these books I would highly recommend, and these were two of the first books that I've read first getting into candlestick charting. Candlesticks is a tug of war between the bulls, buyers, versus the bears, sellers. Why candlesticks? Candlestick charts are a visual aid for decision making. They show emotions by visually representing the size of price moves with different colors. Candlesticks are useful when trading as they show 4 price points: the open, close, high, and low, throughout the period of time the trader specifies. In order to create a candlestick chart, you must have a data set that contains open, high, low, and close values for each time period you want to display. The hollow or filled portion of the candlestick is called the body, also referred to as the real body. The long thin lines above and below the body represent the high and low range and are called shadows, also referred to as wicks and tails. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. If the stock closes higher than its opening price, a hollow candlestick is drawn with the bottom of the body representing the opening price and the top of the body representing the closing price. If the stock closes lower than its opening price, a filled candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. And to give you a couple more examples, on most charts that you see from other traders, for bullish candles, you're either going to see a white candle or a green candle. A bullish candle opens up at the bottom, and it may move up a little bit, and then once it moves down and crosses below the open, that's when we can get the wick or shadow that you see right here. That's the low of the candle. And as the bulls push prices up, that's what forms the body on a bullish candle. And it may run all the way up, and the bears may bring it back down. And then once a candle closes for that specified time frame that you're looking at, it closes at the top, forming a green candle. Now if we move over to a bearish candlestick, you're either going to see black candlesticks or red candlesticks. A bearish candlestick is just like a bullish candlestick. The only difference is the open and closing price on the candles are flip-flopped. So for bullish candles, the opening price is at the bottom. For bearish candles, the opening price is at the top. And then for bearish candles, the closing price is at the bottom. As for the bullish candlestick, the closing price is at the top. A good way to remember this is bulls push prices up, resulting in green or bullish candlesticks, and bears push prices down, resulting in bearish candlesticks. Compared to traditional bar charts, many traders consider candlestick charts more visually appealing and easier to interpret, each candlestick provides a simple, visual, appealing picture of price action. A trader can instantly compare the relationship between the open and close, as well as the high and low. The relationship between the open and close is considered vital information and forms the essence of candlesticks. And here's a comparison of candlestick charts compared to bar charts. And based on your eyes, for me, candlesticks, like I just stated, is more appealing visually than bar charts. Now we're going to get into the different kinds of candlesticks. Long versus short bodies. The longer the body is, the more intense the buying or selling pressure. Conversely, short candlesticks indicate little price movement and represent consolidation. So big candlesticks like this, there's big range on the price chart. Tiny little candlesticks like this, there's not much price movement going on. Prices are at a standstill pretty much. Long white candlesticks show strong buying pressure. The longer the white candlestick is, the further the close is above the open. This indicates that prices advance significantly from open to close and buyers were aggressive. While long white candlesticks are generally bullish, much depends on their position within the broader technical picture. After extended declines, long white candlesticks can mark a potential turning point or support level. If buying gets too aggressive after a long advance, it can lead to excessive bullishness. Long black candlesticks show strong selling pressure. The longer the black candlestick is, the further the close is below the open. This indicates that prices declined significantly from the open and sellers were aggressive. After a long advance, a long black candlestick can foreshadow a turning point or mark a future resistance level. After a long decline, a long black candlestick can indicate panic or capitulation. Even more potent long candlesticks are the Marabas Brothers. Black and white, Marabas do not have upper or lower shadows, and the highs and low are represented by the open or close. A white Marabas forms when the open equals the low and the close equal the high. This indicates that buyers controlled the price action from the first trade to the last trade. Black Marabas forms when the open equals the high and the close equals the low. This indicates that sellers controlled the price action from the first trade to the last trade, pretty much indicating this was all buying here on the bullish candlestick and this was all selling on the bearish candlestick. There are no upper wicks or lower wicks. The upper and lower shadows on candlesticks can provide valuable information about the trading session. Upper shadows represent the session high and the lower shadows the session low. Candlesticks with short shadows indicate that most of trading action was confined near open and close. Candlesticks with long shadows show that prices extended well past the open and close. I personally like to look for long shadows or wicks near support or resistance. If I see a bunch of upper shadows at a resistance level, that's telling me there's a seller up there, an iceberg order. If I see a bunch of long shadows at a support level, that's telling me there's a buyer there, and prices keep coming down, hitting that buyer, and coming right back up. Long versus short shadows continued. Candlesticks with the long upper shadow and short lower shadow indicate that buyers dominated during the session, bidding prices higher, but sellers ultimately forced prices down from their highs. This contrast of strong, high, and weak close resulted in a long upper shadow. Conversely, candlesticks with long lower shadows and short upper shadows indicate that sellers dominated during the session and drove prices lower. However, buyers later resurfaced to bid prices higher by the end of the session. The strong close created a long lower shadow. Spinning tops. Candlesticks with a long upper shadow, long lower shadow, and a small real body are called spinning tops. One long shadow represents a reversal of sorts. Spinning tops represent indecision. The small real body, whether hollow or filled, shows little movement from open to close, and the shadows indicate that both bulls and bears were active during the session. Even though the session opened and closed with little change, prices moved significantly higher and lower in the meantime. Neither buyers nor sellers could gain the upper hand, and the result was a standoff. After a long advance or long white candlestick, a spinning top indicates weakness among the bulls and a potential change or interruption in trend. After a long decline, a long black candlestick, a spinning top indicates weakness among the bears and potential change or interruption in trend. You can also look at spinning tops as dojis, we will get to in a moment, but just think of spinning tops as indecision. It's a draw between the bears and the bulls. Nobody was able to win that candlestick. Now after spinning tops, we get to doji. Doji represents an important type of candlestick, providing information both on their own and as components of a number of important patterns. Doji form when a security's open and close are virtually equal. The length of the upper and lower shadows can vary, with the resulting candlestick looking like a cross, inverted cross, or plus sign. Alone, doji are neutral patterns. Any bullish or bearish bias is based on preceding price action and future confirmation. The word doji refers to both the singular and plural form. And just like the spinning tops, we have dojis. Spinning tops have a little bit bigger of a body, but dojis, like I just stated, they look like a plus sign or a cross. There was very little price movement, and prices opened and closed pretty much at the exact same area. And dojis can vary in size also. They can make an extreme high or an extreme low and come back down. So you could see a big huge doji like this. Just remember, with the doji, prices open and closed near the same area. And again, it's a draw between the bears and the bulls. Nobody was able to win that candlestick. And traders and investors like to look for dojis at the end of a trend, at resistance, at support, to anticipate a reversal. Different securities have different criteria for determining the robustness of a doji. A $20 stock could form a doji with a 1 point difference between the open and the close, while a $200 stock might form a doji with a 1 1/4 point difference. Determining the robustness of the doji will depend on the price, recent volatility, and previous candlesticks relative to previous candlesticks. The doji should have a very small body that appears as a thin line. Steve Neeson notes that a doji that forms among other candlesticks with small real bodies would not be considered important. However, a doji that forms among candlesticks with long real bodies would be deemed significant. Ideally, but not necessarily, the open and close should be equal, While a doji with an equal open and close would be considered more robust, it is more important to capture the essence of the candlestick. Doji convey a sense of indecision or tug of war between buyers and sellers. Prices move above and below the opening level during the session, but close at or near the opening level. The result is a standoff. Neither the bulls nor bears were able to gain control, and a turning point could be developing. Doji and trend. The relevance of a doji depends on the preceding trend or preceding candlesticks. After an advance or long white candlestick, a doji signals that the buying pressure is starting to weaken. After a decline, a long black candlestick, a doji signals that selling pressure is starting to diminish. Doji indicate that the forces of supply and demand are becoming more evenly matched, and a change in trend may be near. Doji alone are not enough to mark a reversal, and further confirmation may be warranted. So if you're looking for a reversal and you spot a doji at the top like this, we have our buying pressure moving up, and then we get this doji. Confirmation of the reversal would be the next candlestick being a bearish candlestick moving its way down. Now if we have a long selling candlestick and the next candle is a doji, to confirm the reversal, we would want to see a bullish candlestick form and develop. After an advance or long white candlestick, a doji signals that buying pressure may be diminishing and the uptrend could be nearing an end, whereas a security can decline simply from a lack of buyers. Continued buying pressure is required to sustain the uptrend. Therefore, a doji may be more significant after an uptrend or long white candlestick. Even after the doji forms, further downside is required for bearish confirmation. This may come as a gap down, long black candlestick, or decline below the long white candlestick's open after a long white candlestick and doji. Traders should be on the alert for a potential evening Doji Star. Long black candle plus doji. After a decline or long black candlestick, a doji indicates that selling pressure may be diminishing and the downtrend could be nearing an end. Even though the bears are starting to lose control of the decline, further strength is required to confirm any reversal. Bullish confirmation could come from a gap up, long white candlestick, or advance above the long black candlestick's open after a long black candlestick and doji. Traders should be on the alert for a potential morning Doji Star. Long-legged dojis have long upper and lower shadows that are almost equal in length. These dojis reflect a great amount of indecision in the market. Long-legged dojis indicate that prices traded well above and below the session's opening level, but closed virtually even with the open. After a whole lot of yelling and screaming, the end result showed little change from the initial open. These candlesticks indicate a lot of indecision, a big tug of war between the bulls and the bears. And something to keep in mind with long-legged dojis and candlesticks in general is the price range. If a stock is $1, most likely the candlestick's range is gonna be 5 cents, 10 cents. Compared to a stock that's $20, one candlestick could have a range of 25 cents to 50 cents. So it's always important to keep in mind with candlesticks, the price and the range, the price range with the candlesticks. Managing your risk and reward with these candlesticks. Dragonfly Doji form when the open high, and close are equal, and the low creates long lower shadow. The resulting candlestick looks like a T due to the lack of upper shadow. Dragonfly Doji indicates that sellers dominated trading and drove prices lower during the session. By the end of the session, buyers resurfaced and pushed prices back to the opening level and the session high. The reversal implications of a Dragonfly Doji depend on previous price action and future confirmation. The long lower shadow provides evidence of buying pressure, but the low indicates that plenty of sellers still loom. After a long downtrend, long black candlestick, or at support, a Dragonfly Doji could signal a potential bullish reversal or bottom. After a long uptrend, long white candlesticks are at resistance. The long lower shadow could foreshadow a potential bearish reversal or top. Bearish or bullish confirmation is required for both situations. Gravestone Doji form when the open, low, and close are equal and the high creates a long upper shadow. The resulting candlestick looks like an upside down T. Due to the lack of lower shadow, the Gravestone Doji indicate that buyers dominated trading and drove prices higher during the session. However, by the end of the session, sellers resurfaced and pushed prices back to the opening level and the session low. As with the Dragonfly Doji and other candlesticks, the reversal implications of a Gravestone Doji depend on previous price action and future confirmation. Even though the long upper shadow indicates a failed rally, the intraday high provides evidence of some buying pressure. After a long downtrend, long black candlestick, or at support, focus turns to the evidence of buying pressure and the potential bullish reversal. After a long uptrend, long white candlestick, or at a resistance, focus turns to the failed rally and a potential bearish reversal. Bearish or bullish confirmation is required for both situations. Bulls versus bears. A candlestick depicts the battle between bulls, buyers, and bears, sellers, over a given period of time. An analogy to this battle can be made between two football teams, which we can also call the Bulls and the Bears. The bottom intraday session low of the candlestick represents a touchdown for the Bears, and the top intraday session high a touchdown for the Bulls. The closer the close is to the high, the closer the Bulls are to a touchdown. The closer the close is to the low, the closer the Bears are to a touchdown. While there are many variations, I have narrowed the field to 6 types of games or candlesticks. Bullish candles. Long white or green candlesticks that indicate the bulls controlled the ball, trading for most of the game. And remember, prices opened up at the bottom. Buyers was able to push the price up and it was able to close higher than the opening price, resulting in a green big body. And the wicks at the top is the session high and the wick at the bottom is the session low. Bearish candles. Long black candlesticks indicate that the bears controlled the ball, trading for most of the game. Bearish candles open at the top. Sellers was able to push prices down and close lower than the opening price at the bottom. The upper wick is the high session. The lower wick is the low of the session. Small candlesticks indicate that neither team could move the ball and prices finished about where they started. And I have a picture here trying to compare small candlesticks with larger candlesticks. I have it circled right here, a bunch of very small candlesticks with small bodies. And on the left side of the chart, we have bigger candlesticks. With small candlesticks like this, There's not much range going on. Things are really quiet. The bulls or the bears are not making much noise at all. Long lower wicks, either hammers or hanging man. A long lower wick indicates that the bears controlled the ball for part of the game, but lost control by the end, and the bulls made an impressive comeback. With long lower wicks, it doesn't matter if it's a bullish open or a bearish open. With these long wicks, bears were able to bring prices down, and then the bulls were able to bring prices right back up. Long upper wicks, inverted hammer or shooting star. A long upper wick indicates that the bulls controlled the ball for part of the game, but lost control by the end, and the bears made an impressive comeback. Again, it doesn't matter with the candle. It could be a bullish candle open here or a bearish candle open right here. The bulls were able to rally and bring prices up, but at the end, the bears were able to bring prices right back down. And for a green candlestick, if it closed above the open, and if it was a bearish candlestick, prices would have closed below the open. The more you practice with candlesticks, looking at them, identifying them, the more you will get used to how all of these candlesticks work and the names for them. What I personally did was I got flashcards, or I got an app on my phone, and every day or every weekend I would just run through the different types of candlesticks. Spinning tops. A long upper and lower wick indicate that both the bears and the bulls had their moments during the game, but neither could put the other away, resulting in a standoff. And again, it doesn't matter if it's a red candle or a green candle. With spinning tops, we have our long wicks at the top and our long wicks at the bottom. They're both going to be equal with small real bodies. That's a standoff. Neither could win. This is resulting in indecision. The bears and the bulls had a tug of war and nobody won. What candlesticks don't tell you. Candlesticks do not reflect the sequence of events between the open and close. Only the relationship between the open and the close. The high and the low are obvious and indisputable, but candlesticks and bar charts cannot tell us which came first. Therefore, we look at multiple time frames to get a glimpse of price action and the way the stock has traded. And these are just different examples of the different charts. Your candlestick charts on the left here, your bar chart in the middle, and your line chart. With candlesticks, what they're saying in this paragraph here, if you're looking at a 10-minute time frame, one candlestick is 10 minutes. Yeah, it can tell you the high with the wick, the low with the bottom wick, the opening price, and the closing price. But all in the middle right here, all up in here, we don't know which came first. We don't know if the stock opened, made a low, ran up to a high, back down to the low, and then closed, or opened, made its low, shot up, made its high, and then closed. This is why we look at multiple time frames as traders and investors. We'll look at 10-minute time frames, 5-minute time frames, 1-minute time frames. We'll narrow it down to get an idea of how price has traded when looking at these candlesticks. Ideally, with candlesticks, you'll start at the daily, weekly, look at the biggest time frame, and work your way down.
The most valuable commodity I know of is information. Wouldn't you agree?